please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
We are not taking that promised break because I think the IIP numbers are with us. The poll had expected 6.1%, and I'll just give it to you in a minute. The number we are staring at, okay, just a minute.
I think broadly,
the general index is up 4.4%. Is that it? The month of March is 4.4% compared to the year ago level. Actually, our poll threw up 6.1%, and last month we had 7.1%.
Correct.
Which was why we were under the impression that, you know, maybe a good run can be expected. 4.4 is a bit of a nasty jar. If it's only 4.4% higher, then, you know, there will be accordingly lower collections and taxes, lower, you know, it clearly shows industrial output didn't pick up. The poll was 6.1, but there were some people in the poll who also went to 6.5, expecting that the good run will continue. So this is a bit of a nasty jar for those of us who thought that growth was picking up. And now let me come to the general indexes. Okay, 4.4, and therefore now this is the month of March. So now you have an April-March number, which is 4.3. Not a very impressive number for industrial output for the year. It's only 4.3. And what are the constituents? Electricity has come in at 5.9%. Mining has come in at 2.8, and manufacturing index has come at 4.4. So manufacturing, which is actually 80% of IIP, is the same as the general index, coming in at 4.4. Not a very enthusing number. One would have thought we could have done better than that. But just a word more on other indices. Consumer, I think capital goods have been so far doing a striking job. So let me give you the capital goods number. I think that's where the disappointment has come. It's a contraction of 1.8%.
In the capital goods segment.
Yeah, capital goods for the last many months has actually been doing exceptionally well, with some double-digit numbers on in several months. See, we had 20% in February, we had 14% in Jan, November, all of them. Right from December, we have been having double-digit numbers. So December, Jan, Feb were all double-digit numbers for capital goods. Even November was a good 9.4%. But capital goods is disappointed with a minus 1.8. Year to date, of course, year on year, it's 4.4%. Primary goods, again, were just 2.9%. Then among other things, I think consumer durables and non-durables would be of interest to us. Okay, consumer durables has done extremely, consumer non-durables has done extremely well at 10.9%. It is durables which have done badly. So all your televisions and cars are not a great March buy. It's only 2.9%. But consumer non-durables, which would include all your FMCGs, you know, from atta, dal, chawal, all the way up to, you know, say soap powder, FMCG products, they've done well at 10.9. They are usually indicative of a good rural uptick. So very good consumer non-durable performance, but very poor consumer durables performance. That's really the story, if you please. Industrial output simply not firing for the month of March. Unfortunate, because we had a fairly good run in the past 3 or 4 months.
Is it the lowest number we've seen in at least the last 5 quarters, as we can see, or is it longer than that? I mean, 4.4 is fairly dismal. We've been seeing 7% rain starting January and February, 7.4.
No, you could well be right. I'm still looking for Ekta's table, which normally is extremely informative on these things. Okay, IIP series, yeah, you're right. We haven't had a number that low until October 2017. So 5 months, yes. November, December, January, February, all those 4 months were 8% and 7%. So we had a very good run from November to February, and it was only October which was 2%, and the months before that. But October, probably we did a lot of restocking in September, so October was pathetic. But nevertheless, the good run which started in the winter months has kind of ebbed at 4.4%. But maybe there is a base effect, I do not know. Let's ask the expert, Anubhuti Sahai, the head of South Asia Economic Research at Standard Chartered Bank, has joined us. Anubhuti, 4.4. What's your take?
Definitely less than expected, and especially if we look at the last few prints, which was consistently above, very close to 7%. So in that context, it's disappointing. But all said and done, the kind of strong growth rates which we were seeing in capital goods, especially, and 7 to 8% kind of a growth rate, in our view, was to some extent reflective of pent-up demand. And probably we are now coming closer to a more normalized trend.
Okay. I can spoil your fun a little more. Digestive enzymes, that originally we used to have rubber cables. Yeah. That used to be insulated cables, would just take the number anywhere. 1 month insulated cables would be 100% higher. 1 month it would be 100% lower, and that would take the IIP just anywhere. And the new form of rubber cables is digestive enzymes. Every month you have digestive enzymes and antacids. This time it has contributed 1 percentage point. So without digestive enzymes, you would have actually had a 3.5% or 3.4% IIP number. I mean, that's not the way to look at it, because you can always take some and give some. So we will work with 4.4. But really, this is destroying the credibility of the data, isn't it, Anubhuti?
If you
well, maybe you want to repeat that sentence, Anubhuti. You weren't very clear. I think you're using a cell phone.
Okay, sure. So of course, if you look at something like pharma contribution to overall IIP, that has been pretty erratic. But if you focus on, say, last 5 to 6 months, IIPX pharma has been doing well. In comparison to 0.9% growth, which was the case in H1 FY18, we have clocked a growth rate of close to 6%, barring the shock which we saw. And even if you look at the manufacturing sector, in the first half of FY18, out of 23, only 10 were growing in the positive terrain, and now that has expanded to 15. So I would still say there is, recovery theme remains intact. It is still broad-based, but probably over the past few months we were getting carried away a lot because we were consistently getting 7 after 7. So more of a normalization rather than, I would say,
and these are lumpy products. So point taken. But just to add a little more color, we now have, of course, the year-on-year figures. And you may be enthused to know that this 4.3% IIP is probably because we manufactured less tobacco. Tobacco products have fallen by 17.9% year-on-year. But I think I'm trying to make light of it. Wearing apparel have fallen by 11%. And paper products have fallen by about 6.5%. Printing and reproduction of recorded media and paper products have fallen by 4.6%. Doing very well, actually, Anubhuti, is pharmaceuticals. Pharmaceuticals year-on-year is up 23%. So, I think you will have to go through the data a little more in detail. Basic metals have contributed very well. All these are, of course, year-on-year figures. Year-on-year, basic metals, pharmaceuticals, fabricated metal products, computer, electronic and optical products, all these have been the positive contributors, and negative contributors have been tobacco.
Well, it's a bad good, how the economists have to say. So, maybe it's a good thing that there's been some shrinkage in the uses of tobacco. But overall, the numbers have been fairly disappointing. Anubhuti, is she still with us?
Yes.
I don't know. Anubhuti, if you can hear me, what would you say, what sort of sense does it give you overall from what we've seen of the core data, and now we're seeing the IIP numbers coming as a big disappointment? What do you see the future course of rates also to be?
No, Anubhuti, you have to repeat yourself.
In comparison, so if you look at FY17 and FY18 average IIP growth, annual growth, it was closer to 4.5%. I would expect FY19 numbers to be better, but probably we are likely to end up, somewhere closer to say 5.5%. But again, probably I'm repeating myself. The kind of numbers which we were seeing over the past few months looked a little bit more optimistic. So improvement is there, but closer to say 5.5% going forward. And I think one for this particular release specifically is on the mineral sector.
I think we have Anubhuti on a bad line, but anyway, we leave it at that. March IIP at 4.4%, capital goods and manufacturing leading the bulk of this slip that we've seen in this quarter. Hopefully, it's just a blip.
The happy part is the IIP has not always been a very good indicator of growth. It is directionally good, but it's not in absolute numbers. So maybe directionally we did slow in March, but not as much as the number indicates.
All right. On that note, we'll take a very short break. We'll continue our discussion, news and updates, and more on the other side.